Money, right? It's literally the fuel that makes our entire modern world go round. But have you ever actually stopped to think about how it all works under the hood? I mean, how does the money you earn at your job sit in a bank account, get loaned out to build giant skyscrapers, and somehow find its way into the hands of massive global institutions? Well, in today's Explainer, we're demystifying this whole financial system. We're going to map out the incredibly interconnected world of organizations that creates, moves, and multiplies global wealth. Think of it like a giant machine, because let's be real, most of us have absolutely no idea where our money actually sleeps at night. We're going to trace that path, from your everyday paycheck all the way up to the absolute highest stakes tables on Wall Street.
Okay, let's dive into this. Here is our roadmap for today's Explainer. We're starting off with puppet masters and workhorses, then moving into giant pools of capital, high-stakes Wall Street playgrounds, corporate matchmakers and flippers, risk spreaders and gamblers, and finally, we'll wrap it all up with the invisible financial web.
Section 1. Puppet masters and workhorses, central and commercial banks. To really understand this machine, we have to start right at the foundational base layer.
So, at the absolute top of this ecosystem, you have central banks. Think of the Federal Reserve in the US or the Bank of England. You can basically look at them as the government's arm within the finance system. They set the rules, they enforce them, and honestly, they kind of play God with the economy. How? Through what we call monetary policy. This is their main tool for controlling the exact amount of money floating around the economy and dictating interest rates. And it's a super delicate balancing act. Their main goals are, surprisingly simple in theory, but impossibly hard in practice. Keep prices stable by managing inflation and keep people employed.
And this brilliantly illustrates exactly how they pull those levers. When the economy is feeling sluggish, they turn to quantitative easing, or QE. They literally go into the market and buy bonds, which pumps the financial system full of cash and drives interest rates down. Suddenly, boom, borrowing is cheap, businesses expand, folks buy homes, and the economy revs up. But what happens if prices skyrocket and inflation gets crazy? They pivot to quantitative tightening, or QT. They do the exact opposite. They sell bonds, suck that money right back out of the economy, and raise rates to slam the brakes on spending. They're the ultimate puppet masters here, just constantly tweaking the macro dials of our economy.
Now, if central banks are the puppet masters, commercial banks, your JP Morgans or Bank of Americas, are the everyday workhorses. They take idle cash from everyday savers and lend it out to businesses trying to expand. But here is a massive twist, and honestly, I found this absolutely fascinating. Do you know what the reserve rate is for most major economies these days? Like the actual amount of cash they are legally required to hold in reserve against your loans? It's 0%. Zero. Let that sink in for a second. When banks issue a new loan, they don't just take my deposit and hand it to you, they literally create brand new money out of thin air in the process. They're expanding the money supply dynamically, acting as the beating heart of the whole system.
Okay, so we all know your paycheck lands in those commercial banks. That's the part we actively see. But for a ton of people, before that money ever even hits a checking account, a silent, invisible cut, usually around 10%, gets siphoned right off the top. So where exactly is that going?
Section 2. Giant pools of capital, pension and mutual funds. This is where everyday money aggregates into unbelievable global power.
That invisible 10% cut, it's almost always going straight into a pension fund. Collectively, these funds control a staggering $60 trillion worldwide. $60 trillion. They are quite literally the biggest financial institutions on the planet. And since they're designed to keep retirees from going broke, they definitely aren't just letting this mountain of cash sit around. They invested incredibly aggressively. They own the literal skyline. I mean, massive global landmarks like Hudson Yards in New York, funded by pension money. And crucially, because they have so much capital to deploy, they act as the largest single source of funding for private equity and venture capital. While you're young, pensions feel totally invisible, but they quietly run the global finance game.
Let's move to and see how this builds when everyday folks want to invest outside of their pension. They usually look at mutual funds. Think of these like giant investment clubs for regular people. Because trying to buy 500 different stocks yourself with a few $1,000s is basically impossible and super tedious. You pool your money with others to buy massive baskets of assets through places like Vanguard. Now, you generally have two flavors here. First, active management. This is where high-paid finance pros work around the clock, researching and stock picking, trying to beat the market. Naturally, you're paying much higher fees for that. Then you've got passive management. This just uses simple algorithms to copy an index, like the S&P 500. It's way cheaper, completely hands-off, and honestly, highly effective for regular diversification without the stress.
Section 3. High-stakes Wall Street playgrounds, hedge funds. Because what if you want to play in the big leagues?
Now, what's really interesting about this breakdown is the absolute staggering contrast between the safe, dry world of mutual funds and the pure chaos of hedge funds. First off, access. Mutual funds are for everyone. But hedge funds, giants like Bridgewater or Citadel, require you to be an accredited investor. You literally need $1 million net worth or a massive salary just to walk through the door. And the fees? Oh, prepare for the infamous 2 and 20. That is a 2% flat management fee just for existing, plus a massive 20% cut of all your profits. Why on earth would anyone pay that? Well, because of the risk and potential reward. Hedge funds use insanely risky strategies. They use massive leverage to borrow money, they short sell to bet against companies failing, and they dabble in wildly complex derivatives. Now, the funny thing is, most of them actually underperform a basic, boring index fund. But the legends? Guys like Jim Simons have averaged annual returns that actually triple Warren Buffett's. It is the ultimate high-risk, high-reward playground.
Section 4. Corporate matchmakers and flippers, investment banks, and private equity. Moving up the financial food chain, we hit the big institutional dealers.
Investment banks, think Goldman Sachs or Morgan Stanley, are essentially the corporate matchmakers connecting massive businesses with monumental piles of money. These matchmakers have three main masterpieces. First, initial public offerings, or IPOs. Remember when Morgan Stanley took Facebook public back in 2012? They raised $16 billion in a single day. Second, mergers and acquisitions. When one massive company buys another, it gets incredibly messy. Investment banks deploy literal armies of analysts to value the target and make sure their client isn't buying a financial dumpster fire. And third, raising massive capital. They convince investors to hand over the cash. Now, usually, this builds legitimate businesses, but the banks themselves are purely impartial. Sometimes they raise billions for sovereign wealth funds that turn into globe-spanning scandals, like the infamous 1MDB fund in Malaysia, where billions seemingly just vanished into yachts and real estate. The bank's job is simply making the billion-dollar deal happen, no matter what.
So the crucial point is how these massive deals get structured, particularly by private equity firms. Enter the leveraged buyout, or LBO. Private equity firms are basically house flippers, but for entire corporations. By definition, a leveraged buyout is when they buy a business using a mountain of borrowed money, and then, here's the tricky part, they sneakily dump that new debt directly onto the purchased company's own balance sheet.
The private equity playbook almost always goes exactly like this. First, they buy a target company using maximum leverage, which means mostly debt. Then, they dump all that debt directly onto the company's books. This is the ultimate safety net for the PE firm. If the company goes bankrupt, the private equity firm itself owes absolutely nothing. Next, they step in and strip operations, execute fire sales, and implement short-term fixes just to make the balance sheet look pretty. Finally, they flip the company a few years later. When it works, it's unbelievable. Blackstone bought Hilton, put in just $5.6 billion of their own money, and walked away with $14 billion in pure profit 11 years later. But when it goes sideways, the target company just gets crushed under the debt. Look at Toys R Us. Loaded with $5 billion in debt by KKR and Bain, it was paying $400 million a year just in interest until it finally collapsed. And the private equity guys? They just shrug, collect the management fees, and move on to flip the next one.
Section 5. Risk spreaders and gamblers. Insurance companies and venture capital. Welcome to the realm of pure probability.
Venture capital operates on this fascinating concept known as the power law. VCs are, essentially, gamblers. They take millions from pension funds and insurance companies who, by the way, are quietly recycling your idle monthly premiums into these global markets instead of letting that cash gather dust. VCs take that money and just throw it at early-stage startups. If a VC bets on 100 startups, the math is absolutely brutal. About 90 of them will completely fail, totally wiping out the investment. Another 7 or so might just break even. But those remaining 2 or 3, those are your 10,000x massive winners. Think of Peter Thiel taking a $500,000 bet on this quirky little site called Facebook, which turned into over $1 billion. Those tiny handful of unbelievable winners cover all the losses of the other 97 companies combined and generate immense wealth.
Section 6. The invisible financial web. The giant machine. Time to bring all these gears together.
We've seen all the gears of the machine today, haven't we? Central banks pulling the macroeconomic strings, commercial banks expanding the money supply out of thin air, pensions and mutual funds aggregating your lifelong savings, hedge funds and venture capitalists taking massive bets,
and private equity flipping entire corporations. It is a vast, perfectly interconnected ecosystem. Every paycheck you earn, every single loan you take, every premium you pay is actively fueling this invisible web that keeps the global economy alive. You are a part of this machine, whether you realize it or not. So the question I want to leave you with today is this. Now that you can finally see the invisible web, where exactly is your money flowing right now? Thanks for joining me for this explainer, and keep exploring.